Hi, this is Kriti and welcome to Corporate Lens. Today I'll be talking about the big policy change 100% foreign direct investment in the insurance sector. What does this really mean? Why were the caps earlier? And how does this change affect the Indian insurers, foreign players, and consumers like you and me? So let's break this down simply. So, what does 100% foreign direct investment in insurance mean? Foreign direct investment means investment by foreign companies in Indian businesses. When India allows 100% FDI in insurance, it means a foreign insurance company can now fully own an Indian insurance firm. Earlier, foreign companies needed an Indian partner and could not own the company completely. Now they can, subject to Indian regulations. This is not about removing regulation. The sector will still be regulated by IRDAI, India's insurance regulator. So, what has changed is the ownership and not the oversight. So, how did FDI or foreign direct investment in insurance start in India? To understand why FDI in insurance is important, let's go back a bit. India has progressively liberalized FDI in insurance over the past 25 years. In year 2000, the FDI limit was imposed at 26%. Insurance sector opened to private and foreign investors after decades of monopoly by LIC. In 2015, the FDI limit was increased to 49% to attract more capital and know-how. In 2021, the FDI limit was increased to 74%, further liberalized with stricter governance safeguards. And now in 2025, the FDI limit has increased to 100%, now legislated to full foreign ownership. So each step aims to progressively open the sector while ensuring regulatory safeguards. So, what were the bottlenecks in keeping caps earlier? Under the 74% regime, the first bottleneck was mandatory Indian partner requirement. Foreign investors had to find and partner with Indian entities for the remaining stake, which was often daunting due to cultural fit, business strategy differences, and long negotiations. The second bottleneck was operational constraints. Foreign players faced restrictions on management influence and had to retain a minimum Indian presence on boards and in key positions to protect national interest. These made entry and decision making less attractive compared with the markets which had full ownership rights. And the third bottleneck was the capital intensive nature. Insurance is asset heavy, it requires huge funds to undertake risk. Without full control, some global players hesitated to scale up their investment. So, why did India need 100% FDI in insurance? Number one, more capital for a growing market. Insurance requires long term funding. Full ownership encourages fresh global investment, especially from large insurers and global funds, to increase the sector's capital base. Second, higher competition and innovation. International players often bring product diversity, digital capabilities, and risk management systems and global underwriting standards, potentially modernizing the offerings made by Indian insurers. The third, increase insurance penetration. India's insurance penetration remains well below the global average. Opening up can boost awareness, distribution, and adoption, helping close a protection gap. Aligning with global practices, countries like Canada, Australia, Brazil, and China permit 100% foreign ownership in insurance, making India's regime competitive and attractive for international firms. And lastly, the policy objectives. The reforms align with the goal of achieving insurance for all by 2047, expanding coverage and financial inclusion. So, what happens after we get 100% foreign direct investment? There are potential advantages for the Indian insurance sector that we need to understand. Higher capital inflows and investment in technology and distribution will be the first advantage. Then there will be global best practices in product development, risk management, and customer servicing. There will be an increased competition, potentially improving operational efficiency and service quality. There will be a faster market entry. Foreign insurers no longer need domestic partners. That will speed up expansion. Then there will be more product choices, customized and innovative policies for policyholders. There will be potential for better customer service as competition increases. And lastly, there will be an improved adoption in technology, particularly in digital onboarding, analytics, and claims processing. Now, there are potential disadvantages and the risks involved in 100% FDI in the insurance sector. The first disadvantage will be the foreign dominance concerns. Some fear foreign firms could dominate key segments, potentially sidelining local players without proper safeguards. However, regulators still retain oversight through IRDAI. The next disadvantage is profit repatriation. Now, if not suitably managed, significant profits may be sent abroad rather than reinvested locally, reducing capital retained in the Indian economy. Next, competitive pressure on domestic players. Small Indian insurers may struggle to compete with global giants unless they modernize quickly. Regulatory challenges. Greater foreign presence necessitates stronger regulatory vigilance, like consumer protection, insolvency standards, and in claim settlement norms. And there will be a risk of global volatility also. Full exposure to global economic swings could make the local insurance sector more sensitive to international shocks in the capital markets. Have we wondered how the insurance penetration is around the world? The insurance penetration is the ratio of total insurance premiums to GDP, and that shows how deeply insurance is embedded in an economy. Insurance premiums account for about 3.7% of India's GDP, which is lower than both the global average of 7% and many Asian peers. Developed markets often have double digit penetration, like 9 to 12% plus. The insurance density per capita is 889 US dollars globally versus just 95 US dollars in India. Now, have you wondered? There are a couple of reasons why Indians hesitate or remain uninsured in India. Number one, people don't understand benefits or how insurance works. Then the premiums are seen as expenses and not protection by them. Then there are limited distribution in non urban areas. There is a fear of claim rejection and complicated terms. And lastly, there is a preference for cash savings over the financial products. So, 100% FDI in insurance sector is about bringing in capital, expertise and competition to a sector that India desperately needs to grow. If implemented well, this could improve the coverage, financial security and service quality for millions of Indians. But success depends on the strong regulation and fair competition, and that is a real test ahead. If you like this video, then do like, share, and subscribe for more such insights. And thanks for watching Corporate Lens.